90% of traders fail within 90 days. Not because they can't pick stocks. Because they don't manage risk. One bad trade wipes out their account. In this video, I'm teaching you the 1% rule, the single most important concept in trading. Master this, and you'll survive long enough to become profitable. This is episode 7 of Zero to Trader Academy. Your financial life depends on this one. The 1% rule is simple: never risk more than 1% of your account on a single trade. If you have a $10,000 account, your maximum loss per trade is $100. Not $1,000. Not $500. $100. Here's why this matters: lose 10 trades in a row. You're down 10%. Recoverable. Lose 20 trades. Down 20%. Still in the game. But risk 10% per trade? 10 losses and you're at zero. Game over. Trading is a numbers game. You will have losing streaks. The 1% rule ensures you live to trade tomorrow. My first year, I risked 5% per trade. Thought I was hot stuff. Had a 6-trade losing streak. Lost 30% of my account in 2 weeks. 30%. Took me 6 months to dig out of that hole. Now I risk 1%. Sometimes 0.5% on shaky setups. I'm still here. That's the point. Here's how to calculate your position size using the 1% rule. Step 1. Determine your account size. Let's say $10,000. Step 2. Calculate 1%. That's $100. This is your maximum loss. Step 3. Identify your stop-loss level. You bought QQQ at 400, stop at 398. That's a $2 risk per share. Step 4. Divide max loss by risk per share. $100 divided by $2 equals 50 shares. That's your position size. 50 shares. Not 100. Not 200. 50. If the trade hits your stop, you lose exactly $100. 1%. You live to trade tomorrow. Now let's talk about risk-reward. This tells you whether a trade is worth taking. Risk-reward ratio: how much you could make versus how much you could lose. Example: you buy QQQ at 400. Stop at 398, $2 risk. Target is 406, $6 reward. Your risk-reward is 1 to 3. You're risking $1 to make 3. Minimum acceptable: 1 to 2. Never take a trade where you're risking more than you could make. Ideal: 1 to 3 or better. These trades compound your account fast. Here's the math: with a 1 to 3 ratio, you can be wrong 60% of the time and still break even. That's powerful. I used to take every setup that looked good. Now I measure first. If the reward isn't at least twice the risk, I pass. I'd rather sit on my hands than take a bad trade. Patience pays. Your homework: calculate your position size for every trade before you enter. No exceptions. Write it down. Account size: 1%, stop level: shares. Every single time. In episode 8, I'm covering technical indicators: which ones actually work, which ones are noise, and how to use them without overcomplicating your charts. See you there. And remember: survive first, profit second.